All right, just a quick update on a long on the ES that we got into today on the back of a break of the trend resistance as well as the 200 MA. From a technical point of view, what is the fundamental reason for liking this to the upside? Quite a few. Equities have continued to recover since that geopolitical scare that we had a couple of weeks ago. The positive thing on that, if we take a look at volatility, volatility has suppressed aggressively over the course of the last few sessions. We looked at that range between 13 and 16. Now, again, I spoke about this earlier today, but it's always important just to note, don't look at this as technical analysis on the VIX. The only thing we're trying to show here is the range that the markets have gotten used to from an implied volatility point of view when it comes to the VIX. It's always important when we assess whether the VIX is low or whether the VIX is high to look at where we are just coming from. What happened in the last month, the last 2 months, 3 months, etc. And what we saw from November, December is that the markets got used to that range between, let's call it 1250 and about 1550, 16 to the upside. So what we've been looking for from a short-term equity upside point of view is looking for volatility to suppress lower and potentially break back inside that range, which of course we got a couple of, let's just say a week or so ago. So volatility being suppressed is one thing that I like about equities here as well. And let's talk about the Fed. The Fed's decision last week should give equities some peace of mind that it will take a lot more on the inflation side to scare the Fed back into hiking rates again. I think that means upside potential for risk assets. The recent soft patch that we have in US data, that is a potential concern for equities going forward. But I think in the short term, the reaction that we saw in equities after NFP and the ISM last week shows us that for now at least, bad news is still good news. Bad data still being good news for equities, at least for now. Obviously, if the data gets really, really bad, that's going to start feeding into earnings expectations, and eventually that's going to start feeding into, should start feeding into negatively to equities. But for now at least, it keeps the Fed at bay, and that should be good for equities in the short term. Again, we spoke about implied volatility being pushed lower. That is important because it gives flexibility for vol-controlled allocators to ease back into equities. That's something that's positive. In terms of earnings, this is obviously the earnings coming up this week, but in terms of earnings season in general, earnings season continues to deliver better than expected results for the most part. Coming into this earnings season, we knew that from a Mag 7 point of view, there was a pretty high bar from an earnings point of view, but not really for the rest of the names. And so far, we've seen decent enough earnings, I think, to continue seeing upside in equities. What's also nice about a week like this, as we spoke about earlier today, is that it's pretty quiet on the data side, right? We've got very little US data, which means there's less chance of being run over by a massive upside surprise in any inflation or growth data. The biggest risk to equity longs this week will be Fed speakers, right? If the Fed speakers this week come, and there's plenty of them, by the way, if the Fed speakers come out this week and they push back aggressively against what Fed Chair Powell told us last week, then that is obviously a risk that we'll need to navigate, right? If they come out and say, listen, no, I do think that hikes are back on the table, that's going to be bad for risk. That could see downside in bonds again, upside in yields. That could see upside in the dollar, and obviously downside in equity. So that is something to watch. But with geopolitical risks obviously fading, with volatility suppressed, with the Fed refusing to put hikes back on the table, with earnings season doing well, I do think there's a higher probability once again for equities to push up. We never work in absolutes. We always work in probabilistic terms. And right now in a week like this, it does seem like probability is skewed more towards the upside for risk assets. So that's just a quick update. Basically just, stops anchored below the 5100 level, below that 5080, looking for a move back up towards all-time highs. Very simple trade. Again, like I mentioned earlier, if Fed speak should come out and they are aggressively hawkish this week, I'll just rotate out of these clips that I got into, right? We don't have to get married to these types of positions. As long as the position makes sense, we'll hang on to it. The moment when the sentiment starts to shift, we can obviously just, pull back from those positions. So just a quick update on the S&P, and any questions, as always, don't hesitate to let me know.